You have to understand that while everyone gets taxed, not everyone gets taxed the same way. It's not always equal, and the way tax works for every place is different. Knowing the differences and how these can work for you is important in order to make sure that you're not paying more than you should. It's doubly important that you know how your state taxes you and what states are considered tax-friendly, especially when it comes to retirement. This is Intelligentsia, real-life advice for practical and financial goals. Today, we want to talk about the tax situation in California, how it can benefit you, and how you can live off in California with ease. So let's get to it. Retirement is always a huge milestone. I mean, you get to stop working and you're gonna be enjoying the rest of your life because you prepared for it. It's a significant milestone. However, it doesn't mean that you're done with taxes. In California, like many other states, you still get taxed during retirement, and that's what we want to focus on today. Retirees still have tax obligations to take care of, and as a result, managing taxes in retirement is an essential aspect of financial planning. California has its own unique tax laws, and we'd like to help you maneuver through it. Retirees need to know how to navigate through these rules in order to make informed financial decisions. The primary forms of taxes that you should be made aware of are income tax, property tax, sales tax, and estate tax. We'll talk about income tax first. In terms of income tax, California has a progressive system with a variety of tax brackets. This means that if you're someone that earns more, you also get taxed more as a result. It works in a sense that the higher your income is, the higher your taxes are in percentage too. In retirement, you make your money through different ways. It could be through social security benefits, pension income, or retirement account distributions. All three are treated differently, and just to go over them, unlike the federal government, the state of California does not tax their social security benefits. Because of this, social security benefits are not subject to the same state income tax laws that apply to the next two. Pension income, however, is subject to state tax laws, with some exemptions that are either partially or fully exempt. Public pensions like the California Public Employees Retirement System, or CalPERS, or the California State Teachers Retirement System, or CalSTRS, are some examples. And for the third one, retirement income from accounts like 401ks and IRAs are treated as ordinary income and are subject to the state's tax laws upon withdrawal. That said, different forms of income are taxed in different ways. Next, we'll move on to property tax. Now, property tax is assessed based on the value of your property. In terms of important matters to take note of when it comes to property tax, retirees should be aware of Proposition 60 and Proposition 90. Now, just to go over it quickly, Proposition 60 allows transfers within the same county. If you're above the age of 55, you can sell your home and buy another home in the same county without having your property tax reassessed. What you need to take note of, however, is that your property needs to be of equal value or less in order for this to be viable. Proposition 90, however, takes it up a notch by extending it towards transfers between two different counties. The downside here is that not all counties participate in Proposition 90. However, for those that do, you can potentially move to a different county while still keeping your previous property's tax base. This effectively allows eligible homeowners who are 55 or older to transfer the base year value of their primary residence to a replacement property within the same county or another participating county. This can lead to significant property tax savings, especially when downsizing or moving in retirement. Because of that, it's a good strategy for retirees that are looking to downsize their homes or just relocate within California. It helps them out by maintaining a lower property tax base value, which then leads to huge savings in property taxes. Those are just some of the key factors that explain property tax in California and what you need to take note of when it comes to that topic. Next up, we need to talk about sales tax in California. This isn't necessarily anything specific to retirees, but since it's part of what we're trying to mitigate, which is overall taxes, we'd like to brush over just some of the basics involving state tax. Sales tax in California is imposed nationwide, and some local jurisdictions can even add additional state taxes on top of what's already imposed. Apart from that, it's a fairly straightforward thing in California that's widely imposed and is a general rule not just for retirees, which leaves us to estate tax. This one is fairly brief as there's no estate tax in California. That said, you still have to watch out for federal tax if you're leaving a pretty hefty amount of money to your heirs. Now that we've covered the tax situation in California and how it affects you, we need to talk about strategies to manage your taxes in retirement. Now that you understand the basics of California's tax landscape for retirees, it's crucial to know strategies to take advantage of this information effectively. For the first one, we need you to plan ahead and understand your financial situation. As with everything that involves finances, retirement should always include planning. Consider the following. Estimate your retirement income from your multiple sources, including Social Security, pensions, retirement account withdrawals, and other investments. If you have a good estimate of your income from all of your retirement income sources, you can then determine your expected expenses in retirement. Take into account your lifestyle, your anticipated healthcare costs, and any other miscellaneous fees that you may run into. As situations are unique and lifestyles are different, it's important to note that you know how much you'll be spending. You're the best possible person to start planning for yourself, and because of that, you're afforded more freedom in planning your expenses. From there, you can consider the tax implications of different income sources and withdrawal strategies for your retirement accounts. When you're able to plan out your finances and you've considered it from multiple angles, you can proceed to maximizing your tax advantage accounts. Because you're taxed differently for your different sources of income, you can then pick and choose how you can mitigate tax torpedoes. One of the most important things to take note of here is that retirees can still contribute to retirement accounts like IRAs and 401ks. Contributing to these accounts effectively reduces your taxable income. Also, you can consider the benefits of having a Roth IRA as it offers tax-free withdrawals in retirement. Converting traditional IRAs to Roth IRAs can prove to be beneficial, but you always have to think of the tax implications when doing so. One other important aspect about California's tax situation is that you can take advantage of various credits for retirees. California offers a myriad of tax credits and deductions that are specific to retirees. There are many benefits, including the following programs. The Senior Head of Household Credit. This allows homeowners that are 65 years old or older, or if they are blind or disabled, to qualify for a property tax exemption. This helps to reduce the assessed value of your home, which then leads to lower property taxes. The Property Tax Postponement Program, which allows eligible homeowners to defer payment of property taxes. This program allows those individuals with limited income to postpone the payment of their property taxes on their primary residence. This in turn gets paid with interest when the property gets sold or if the property changes ownership. The Senior Citizens and Disabled Citizens Property Tax Postponement Program, which is similar to the above but designed for low-income seniors and disabled individuals. If you've explored your available credits and deductions, you are able to reduce your overall tax liability by a lot. That said, California is known as a tax-friendly state for retirees, and we hope that information we provided helped out in informing you of the matter. There are many other things involving taxes that can help you save up a lot when retiring in the state, but the information that we provided are some of the more important ones to take note of. We always recommend the assistance of a qualified tax specialist, as you never know how much money you can save up in taxes when you're in the hands of a professional. If you've enjoyed this video and found this helpful, please hit the like and subscribe button. We'd like to be able to grow alongside you, and we'll come to have you on our next video. Stay mentally healthy, and let's get financially fit together.